Palantir's stock price has been up by more than 30% in the last month, and I've seen it popping on the most viewed stocks on the StockCard platform for several days. The price jump and excitements are mostly due to the company's latest quarterly earnings report when it reported its first ever GAAP profitable quarter in its history. Combine that with an 18% year-over-year revenue growth, and investors couldn't hold their excitement. Trade volume jumped as investors rushed to pile up Palantir's shares, pushing the stock into even an overbought territory. Are investors right? Does Palantir's performance in the latest quarter deserve the excitement? I dug into the earnings report and found 3 red flags. Stay around to learn about those reasons to avoid Palantir's stock after its latest earnings report. My name is Hoda Mer, founder and CEO of StockCard, and I was initially quite excited about Palantir's earnings report. Double-digit revenue growth, GAAP net income profitability for the first time in the company's history, and significant growth in the non-government side of the business, signaling its ability to expand beyond limited government contracts. On the surface, what's not to like? I must admit the company did a fantastic job portraying an excellent picture of its progress in its earnings report. The story starts with a very aggressive and bullish letter from the company's CEO calling how Palantir's critics were wrong at many levels. Then comes the rave reviews by top-ranked executives of Palantir's customers, such as the CIO of Southern California Edison, or the CTO of Tampa General Hospital. These customers add credibility to Palantir's product superiority, and then comes a series of hand-selected financial metrics such as 1 cent per share GAAP net income profitability, 32% revenue growth in the US, 115% net dollar retention rate, and $2.6 billion in cash and no debt on the balance sheet. At this point, every investor starts salivating over the stock and feels the regret of not buying shares sooner. However, there's a problem with our research so far. We only gathered information to confirm the market's excitement. A few videos ago, we discussed that one of the biggest reasons investors fail in the stock market is that they just pay attention to the reasons they should invest in a company, and they ignore the reasons they might be wrong. This is a phenomenon commonly known as confirmation bias, and it ends up creating a blind spot in our investment research. To get an accurate picture of Palantir's quarterly results and performance, we should dig into the reasons why the earnings report wasn't as exciting as the stock market assumed, and then decide whether we are still ready to buy some shares. When I did my research, I found 3 reasons to avoid Palantir's stock even after its shiny new quarterly earnings report. Let's talk about them. I'm not a financial advisor, by the way, and this video isn't a financial advice. All successful investors know how to research things they invest in or use financial advisors they trust. I recommend you learn to research things on your own or talk to a financial advisor and use my videos as content to inform and educate. Now, the first and most intriguing information Palantir shared with us was its first ever GAAP-based profitability. This means using the generally accepted accounting principles or GAAP methodology, the company turned profitable. But how? How did the company turn profitable? Was its revenue growth so much higher than the cost increase that it had money left at the bottom? Intuitively, you'd assume so. But sadly, that's not the case. When you dig into the company's profit and loss statement, its operations or its principal business were unprofitable. The profit came from unusually higher interest income and other incomes unrelated to its main business. Palantir lost more than $17 million from its quarterly operations and gained more than $12 million in interest income and $44 million due to the net result of losses on marketable securities, the impact of foreign exchange, and gains from a step acquisition of Palantir's Japan joint venture. So the first ever profitable quarter was thanks to higher interest rate and other non-operational factors. The next red flag comes from a little bit more digging into the P&L. We know Palantir is focused on cutting-edge data analytics technology, which means it requires to consistently invest in developing its products. However, Both on a quarterly and year-over-year basis, the company reduced its R&D investment. For example, the full year 22 R&D was more than 7% lower than the year before. That sort of cost reduction can help with short-term profitability, but is not necessarily the best choice for long-term growth for the company. Cutting R&D expenses now may translate to lower revenue growth a few years later, especially if the downtrend continues. The last red flag in the company's latest earnings report is the high amount of stock-based compensation on the company's balance sheet. It is a fact widely discussed among investors, and the company has reduced the figure to $565 million from $778 million the year before. That's good news, but the bad news, or the red flag, is the company issues new shares to its employees as a part of their compensation, and the existing shareholders get diluted. One way to look at it is by calculating the revenue growth per share, which reveals the true wealth generation power of the company for its shareholder. While revenue grew by 24% yearly, revenue per share only grew by 15%. This means the real revenue growth that impacts shareholders' wealth is slower than the figures reported and discussed on the surface. I also believe 2022 happened to be an exceptionally great year for Palantir government contracts because of the Russia and Ukraine war. The global military expenditure surpassed $2 trillion in 2022 as the war sparked a new wave of demand. This may mean the government demand may be at an unusually higher peak, fueling Palantir's top-line growth, and may not be a sustainable trend moving forward. To summarize the 3 red flags, the company's first ever GAAP profitable quarter isn't really due to its profitable operations yet. The R&D decline isn't a good long-term sign, and the stock-based compensation decreases the real growth rate that impacts shareholders' wealth. So what's the bottom line here? Is Palantir a disaster, or is it still worth buying shares? As I said when we started, the goal of revealing the red flags is to avoid falling for confirmation bias and only consider the information that confirms the market's and investors' excitement. They help us create a more balanced view of the company's true performance and potential. Even though the company's real business is still unprofitable, the negative value has shrunk from negative $488 million to negative $161 million. That's still a noticeable improvement in Palantir's profitability. Similarly, despite the 7% decline in R&D, Palantir still has $360 million in R&D, representing 19% of its full year 2022 revenue. And lastly, even though the share count is increasing, the revenue per share still grew by 15%. The company is performing well, even though the headline stories aren't painting the right picture as the reality. The real question is whether Palantir can be the next 100-bagger or even the 10-bagger, a stock worthy of a spot in our portfolios. The company has certainly made progress by growing revenue, and it has a strong balance sheet with more than $2 billion in cash and no significant liabilities. Those are all good indicators. But then, with the red flags discussed today, the final answer may come down to whether we can buy the stock at a reasonable price. With a roughly $18 billion market cap, a 10x return requires a $180 billion market cap. At the time of recording this research, the stock is priced at 10 times its sales, telling us that the 10x growth is already priced in the company's stock price. This doesn't mean its price can't soar any higher. We actually saw a $35 price tag per share for Palantir in 2021, but with a 10x price to sales, it's undoubtedly priced for high expectations. The question you and I must answer for ourselves is if there is a better option out there for our dollars that aren't priced as high and don't come with the red flags we discussed today. I tend to believe there are better choices out there. You may disagree with me. If you do, please share your cases for investing in Palantir in the comments, and don't forget to check the video I published about Shopify, which happens to have a similar 10x price to sales ratio to Palantir. You may or may not find that stock to be a better choice than Palantir for your portfolio. See you next time.